commodities trading on the face are zero sum because eventually someone does buy the soybeans or the oil or something. But if a farmer is growing soybeans and they want some guaranteed price, possibly at a slight cut, then they are willing to sell a futures contract on those soybeans. And then someone who's making a prediction on the eventual price of soybeans when the futures contract matures, they are willing to accept some potential loss in exchange for a slight expected return. So it's trading stability for expected return right there.
That's one way of looking at it, but it's actually more complicated and more positive sum than that.
It's still positive sum for both parties, otherwise they wouldn't engage in the trade.
Let's look at it a different way. Imagine that you're Boeing and you're going to be building a whole bunch of airplanes next year. You know how much the government's going to pay you for that.
You have some prearranged price for airplanes.
Yep. But you don't know what the price of steel is going to be next year.
Okay, so if the price of steel goes up significantly, you're potentially underwater on these planes that you have already sold, in effect.
Yeah, but if you can lock in the price of steel, that is positive value to you because it enables you to make this contract risk-free.
Okay, so in exchange for both the uncertainty and the possibility that you're underwater on the cost of selling the airplane, you've instead locked in a guaranteed profit, provided, of course, that you actually deliver an airplane.
Yeah, which means that your risk-adjusted profit, which is what we care about the whole time, has increased, despite everyone just shuffling money around.
Yes, because it's about managing the risk.
Yeah, now it gets even better, because we're just looking at this from Boeing's perspective. Now let's look at this from a quant firm's perspective. A quant firm looks at the price of steel and says, this price does not match our models of steel production next year. And the quant firm wants to bet on the price going down or up. It doesn't matter. It's all just numbers to these guys.
They have a model and they're trying to make money based on that model. The actual movements are a little bit immaterial.
Exactly. Now, one way they could do this is they could buy steel. If the quant firm bought steel, then they would have to tie up a whole bunch of capital in a warehouse full of steel. If a quant firm just buys a steel future where they buy the right to buy steel next year, then they don't have to store the steel and they don't even have to tie up any money. They only have to pay upon delivery. Because of this, there's implicit leverage to futures contracts where normally if you have $1 million, you can buy $1 million worth of steel. But a quant firm, if they have $1 million, they want to spend $10 million in various futures that'll all balance out.
Okay, that makes sense.
The advantage to the financial firm is they get to gamble on financial markets with far more money than they actually have. And the advantage to Boeing is they get to offload the risk of the financial markets. So from Boeing's perspective, the risk, the price volatility is a risk. From the quant's perspective, the price volatility is all they care about. So you're taking this thing that people don't want and turning it into something people want by dividing it up.
Okay, so then the immediate follow-up question there is, what's stopping Boeing from basically interning the quant firm and cutting out the middleman and doing all of this risk management themselves? Or does that defeat the purpose of the exercise?
In theory, they can do that. In practice, gambling on financial markets is really hard and really risky. And building airplanes takes a completely different skill set. It's just better to have two separate organizations, each specializing in their own thing.
Okay, so this does seem like it ties back into my original assertion. Boeing is trying to offload the risk, and the quant firm is willing to take on that risk because they have something that, based on their model, puts a positive dollar value on that risk.
Exactly. It's not the quant firm is being paid to assume the risk. It's the quant firm wants that risk because they need it.
Because the quant firm doesn't care about the actual price of steel. They just care about the movement and whether or not they can accurately predict that.
Exactly.
Okay, so even if, let's say, the price of steel were to skyrocket to near infinity, or it were to crash down to basically zero, that's immaterial to the quant firm so long as their model properly accounts for it.
Correct.
Okay, so that makes sense.